Alright, could a global financial shift be disguised as a market crash? According to our news right here, we have EGRAG crypto to XRP holders. This setup could be one of the biggest bear traps, right? Imagine walking past a bank vault door that is completely wide open, but instead of rushing in to look inside, everyone around you is running away in absolute terror. That is exactly what is happening in the crypto market right now as we step this month of June 2026. The crowd is panicking. The headlines are screaming that crypto is dead, and the average retail investor is throwing in the towel. But while the masses are running for the exits, a legendary analyst on X known as EGRAG CRYPTO has just sounded the alarm on what could be the single largest bear trap in the history of this entire market cycle. XRP has just hit a massive multi-year decision point. It is sitting in a tight battleground where one single spark could transform the current heavy dark sentiment into a historic launch pad. Alright, in this video we are going to pull back the curtain on this exact setup. We are going to look at why June has historically been a brutal month for this asset and how the big money uses that exact history to manipulate retail investors and where the ultimate structural breakout targets are hidden. Alright, let's look at the chart shared by EGRAG Crypto, and let's first talk about why is June historically the most dangerous month for XRP holders. To understand where we are going, we have to look at the historical data that the bears are currently using to scare people. The analyst shared some incredible eye-opening statistics regarding how XRP performs in June during midterms. If you look back at the historical cycles, the numbers look pretty ugly on the surface, right? Here's the data. If in June 2014 right here, the asset dropped by 17%. Fast forward to June of 2018, and it took a massive 39% hit. Then in June of 2022, it plummeted another 32%. In my opinion, when the average retail traders look at this data, they immediately panic. They think, oh no, it's June again. Time to sell everything and sit on the sidelines. But my personal take on this is completely different. To me, this historical repetition is a psychological playbook used by institutional giants. They know that retail investors remember past again. By driving the price down early in the month, they create a self-fulfilling prophecy of fear. It is the ultimate shakeout strategy designed to force you to hand over your tokens right before the real macro structural shift takes place. Alright? Now, is the $0.90 to $1.30 range the ultimate accumulation zone? Alright, let's check the chart. Right now, the absolute primary battleground for the bulls and the bears is firmly locked between $0.90 and $1.30. The asset is currently trading around the $1.29 level, right at the nice edge of a white macro trendline that has successfully held as rock-solid support through multiple major market cycles. The analyst points out that every single time in history, the price has compressed tightly against this specific line. A massive, explosive advance has followed. In my view, this $0.90 to $1.30 zone is not a danger zone. It is a generational accumulation sandbox. Think of it like a giant dam holding back an entire ocean of global liquidity. The water pressure is building up higher and higher behind the wall, but from the outside, everything looks completely still and frozen. The bears think that the bears think the stillness means weakness. I think the stillness means the market is coiling its energy. Selling your asset inside the very zone where global financial institutions are setting up their buy grids is, in my opinion, the biggest tactical mistake an everyday investor can make. Now, how do the bears get lured into the ultimate trap? The technical structure we are watching right now is a massive falling wedge pattern, bounded by a descending yellow resistance line. Because the price has opened the month below the 50 EMA, the traditional trading algorithms and textbook short sellers are aggressively piling into short positions. They see a bearish market structure, so they borrow tokens and sell them, betting that the price will crater down to zero. This is exactly how the legendary bear trap is set. A bear trap happens when the market looks so incredibly weak that it lures every single short sellers into the room. They all crowd into the exact same trade thinking it's an easy win. But because the asset is sitting directly on a multi-year macro support line, there is an invisible floor underneath them. The moment a wave of buying volume steps in or a major global announcement drops, the price will violently snap back up. When it reclaims that 50 EMA, all those short sellers will be forced to buy back their positions all at once to prevent total liquidation. That forced buying creates a massive vertical short squeeze. Now, what happens once the falling wedge finally explodes? According to the analyst, until we completely break out from that yellow descending resistance line right here, a massive macro bottoming structure is actively forming. The monthly candles are narrowing to an absolute point, meaning the compression phase is reaching its absolute limit. When a compression phase finishes, the resulting expansion phase is usually equal in size to the time spent compressing. So, my perspective on this bottoming structure is that it represents the final transfer of wealth from impatient hands to patient hands. Markets do not move up in a straight line. They compress until the weak hands are completely shaken out of the market. Once that yellow wedge resistance is broken, the structural target projections are absolutely mind-blowing. The analysts here highlighted key Fibonacci extension targets that stretch all the way up to 5.16 dollars, then $6.27, moving to $8.28, and ultimately reaching a macro target of $13.95. While the crowd is crying about pennies at $1.29, the structural architecture of the asset is quietly preparing for a multi-dollar reality. Now, to bring this all together into a clear perspective, we are looking at a market that is deeply disconnected. On the one side, we have overwhelming retail pessimism driven by a seasonal June history and a short-term price action below the 50 EMA. On the other side, we have a historical multi-cycle macro trend line that has never been broken, acting as the foundation for a massive falling wedge pattern. So in conclusion, the data strongly suggests that the current market weakness is a beautifully engineered illusion. June of 2026 is shaping up to be the ultimate sorting ground where emotional traders will be punished and disciplined strategic investors will be rewarded. The compression is almost done. The short sellers are completely taking the bait and the trap is fully set. When the snapback happens, it will be swift, violent, and historic. So keep your eyes on that macro trend line, ignore the short-term noise, and remember that the real wealth is made by doing exactly what the crowd is too terrified to do. And this finally ends our video. Thank you very much for watching and see you on the next one, or you might just as well check this recommended video right here.